The three inside up and down patterns are reversal patterns that typically occur at the end of a downtrend and an uptrend respectively. To identify a three inside up or down pattern, here's what to look for. First candlestick should be found at the end of the current trend and should reflect the current market sentiment according to the trend. Long bullish candle at end of uptrend, long bearish candle at end of uptrend. Second candlestick should have a body that minimally crosses the midpoint of the first candle. Third candlestick must close below the first candle's low for three inside down and above the first candle's high for three inside up. The three inside down pattern is a bullish reversal pattern and is typically found at the end of an uptrend. It consists of three consecutive candlesticks that specifically fulfill the above criteria, thereby signaling to us that the downtrend has most probably concluded and a subsequent uptrend is about to begin. The three inside up pattern is a bearish reversal pattern and is typically found at the end of a downtrend. It consists of three consecutive candlesticks that specifically fulfill the above criteria, thereby signaling to us that the uptrend has most probably concluded and a subsequent downtrend is about to begin. Let's have a look at the three inside down setup in greater detail. As you can see, the three inside down pattern has clearly formed after a steady upwards trend in price, which is a bearish reversal pattern. In this case, what do you foresee about upcoming price action? If you thought that price would fall, then you would be absolutely right. The three inside down indeed marked a point where a bearish reversal occurred as price dipped sharply right after that from 1.24525 to 1.21812 by a total of 271 pips. It's all for today, and if this helped you understand better the topic, make sure to like, subscribe, and hit the notification bell.